Hello everyone and welcome to today's major markets update for March 30th. One more day to go and March will be in the books as well. Trust the Thrust part 2 and 3 versus 5 waves. What is it? Trust the Thrust part 2 because I already did a review of Trust the Thrust last week, I believe it was, and I concluded it was bullish and look where we are now. So should we trust some of the thrusts we continue to see? I think so, but what do I know? All right. Anyway, so let's start with some thrust. This is based on market breadth. Remember, a stock market is better expressed as a market of stocks. The Nasdaq 100 comprises of 100 individual companies that make up the index, based, of course, on their market cap, and their weighting then influences the index. That's all the index does. This continuously buying and selling of individual companies. So if most of the stocks are down, the breadth is bad. If most of the stocks are up, the breadth reading is good. Those are the market internals. So here is the bullish percent index for the Nasdaq 100. It is based on a point and figure chart. You can look up what that means and how to determine it. And it tells you how many of these 100 companies in percentage are on a buy signal and how many are on a sell signal. So if the reading is 50, it means half on a sell, half on a buy. If it's, of course, at 80, then 80% are up and only 20% are on a sell signal. So what do we have right now? Okay, the first thing we need to look at is, of course, how high is the current reading? Well, the reading for yesterday, I think actually for today is 88. So that is quite a strong reading. Somehow stock charts keep messing a little bit there. So that is the reading we have now. Now what we then can do that's the reading right now, 88. So that's pretty strong. 88% of all the stocks that make up the Nasdaq 100 are on a buy signal. Compare that to where we were about 2 weeks ago. Remember, the trigger is to buy a reversal from below 30 to over 30. It failed twice, but third time is the charm. Again, nothing works all the time perfectly, ever. So there will be sometimes it won't work. Now, let's go back to the 88 level. We are 88, so the index is quite strong. How has this indicator worked over the past? Although past performance is no guarantee for future results, that's always the disclaimer. We do know from Mark Twain that history never repeats itself, but it tends to rhyme. So this indicator I have data for since 1995. So it includes essentially 2 bull markets and 2 bear markets. Okay, now a real quick note about the bear market between 2000 and 2003. That was a 80 to 85% haircut in technology sector. I know a lot of people are already dreading the bear market that I forecast going to happen in a couple of years with a 60 to 80% haircut as well. We already had one. And where are we now? Was it really that bad back then? And look where we are now. Okay, so honestly, we've already went through a 80% haircut in the Nasdaq sector. So the earth didn't stop turning. It still became morning. The birds were still chirping. So honestly, all things considered, I'm actually getting less bearish on the world than I was before, knowing that we've already experienced something similar. And out of the ashes, the phoenix will rise. So I'm not too worried about that. Moving on. We have a couple of readings, not too many, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, about 11 readings where it went above 88. That's over, boy, that's almost 30 years of data. So it's a rare occasion we get such high readings. When do we get these high readings? Let's go back. Here, 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 here. So 3 are at the starting gate of a fantastic uprun. Now, I'm sure we can zoom in and look at the little nitty details that maybe there are a couple of down days. We might go down 10%, but remember, forest through the trees, this is good. Then there's just one reading here after the market top. Okay, so that's an outlier. That's 1. It's 3 out of 1. Here, we're at the bull market, bull market. Right here, we're at a decline. and then continued bull market here as well. We're close to a decline, bull market continues, and then we have these couple of readings as well, bull market. So bull, pretty much one is only at a true bear market. All the other ones will see maybe a correction, but continued bull market. So the weight of the evidence on this indicator is we might see a correction and then we move higher. That is 30 years of data. Let's look at the bullish percent index for the S&P 500. All right, it went from almost 30 and it is now at 76. It's not as high as it was here, for example, in April and May of 2020. So this reading is not that strong as the Nasdaq 100. So it is a little we have to be honest and compare apples to apples. So this one is so-so, but still strong. It shows you that most of the stocks in the S&P 500 are advancing. Then we go to an indicator. It's called the McClellan oscillator of the Nasdaq 100. The McClellan oscillator also measures advancing and declining stocks and does some calculation with it. And it tells you that a positive reading means more stocks are advancing than declining. Very simple. And a negative reading means more stocks are declining. Bears need declining stocks. You cannot have a bear market with stocks ramping up. Yes, we can have a bull market with less and less stocks advancing. That is a late stage bull market. That's called the negative divergence. But at the end, it can be 5 stocks holding up a whole index if those are the Apples and the Googles and the Amazons, for in this case, the Nasdaq 100. Yesterday, and you might have seen it, it's probably been announced all over the news, we had a reading of 136.69. That, my dear friends, has never happened before in the entire history of this indicator that I at least have data for. Maybe other people have data that goes back further. I don't. This is since 1999, so this is 23 years of data. We have never had such a high reading. So what can we say about it then? Nothing. There is no comparison with the past, right? We have nothing. N is 0. But it tells us we have very strong breadth, not very low breadth. But just like we sometimes have very low breadth at the bottom of a index and a decline, we might have very strong breadth at a top of a rally. But it is also suggestive of a kickoff wave. So if we just go to the 2 closest ones, that is here in late 2021 and here in the middle of 2011. Those are the 2 closest ones. Well, honestly, we can discard the 2001 reading because we're at the end of a bear market. This has been already seeing a 80% decline or something like that, and a multi-year bear market. We're not even close, so I don't think we can compare this apple with that orange. This is more honestly comparing a walnut to an orange. So this doesn't hold. The only one that's reasonably comparable then is this middle of 2011. I can zoom in. That was a bounce. We dropped about 20%, and then we moved higher. Okay, so it is possible. What is the next highest 2 readings we can find? Well, we don't have to look too far. That is about here. Bull market continues. We might grind sideways for a little while, and it's about here, which is very close to the end of the bear market in 2008. We got very, very close, a couple more months, and then it was over. So also this comparison is not really valid because we're not at the end of a bear market. What is a bear market? You need to lose 50% in the index over at least a year. The index needs to decline for at least a year. We haven't seen that at all, of course, since 2009. So this is a unique reading, and honestly, it is a strong reading. I don't know how otherwise to interpret very strong breadth readings than being bullish. Okay, then we go to the S&P 500. Again, we don't want to stare too much at one index, but compare also other indexes. And yesterday we had a reading of 109. I don't know what the reading is for today, probably a little bit lower since we dropped a little bit. And we're going to compare since 1999. Again, it's 30 years of data. It's pretty much one bull, one bear, one bull, one bull, so and a bear. So 2 bears, 3 bulls. Pretty good track record. The blue ones show the bear markets. Again, we're not in a bear market. This is multi-stage or a multi-year decline, and at the very end of a bear market, we're pretty much, 5% away from the all-time highs. So no, that's why they're in blue. I can't compare those. Okay, then the only ones that are left are here since the 2009 low. We've got to compare apples to apples, and we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 readings. Not too many since about 2009, so once every other year. And again, it shows that we can have some occasions where we're going to face a pretty decent decline. This is here in 2015-16 and here in 2011. All the other ones suggest upside, 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 upside. So the weight of the evidence, even in the bear markets, right, this one and this one, suggest that this is much closer to a bottom than it is to a top, with, of course, one or two variations to this theme. As usual, nothing works all the time. But the weight of the evidence suggests continued upside. We might see a little bit of a pullback to kind of burn off this overbought condition because we cannot continue. It's a little bit too much of a good thing. That's what we're talking about, right? So then we look at the McClellan oscillator for the NYSE, right? That's the broader index. It's been topping at around 70. It's not so high compared to here 2019 and 2020. So it's a little meh. Okay, so it's not the greatest of readings. So we have to be honest. Nasdaq 100 was great. S&P 500 was pretty good. And the broader index is so-so. But please remember the NYSE has barely corrected anything. So it doesn't need as much of a kickoff wave to get going to the upside. I'll show you that in a minute. Then we're going to look at the new lows and the new highs. If we make a lot of new lows, then we're in a downtrend. If we make very little new lows, we're in an uptrend. And today it dropped below 50. 50 is my critical level. And as you can see, the new lows are just simply falling off a cliff. It means the market is calming down. It's starting to make new highs. If individual stocks are making more new highs, that's bullish. So today is just a little bit of a blip in an otherwise strong uptrend from that perspective. Let's look at my PMO buy all sell all indicator. It's still on a buy. We are in what I call the ideal sell zone, which means when we get a sell trigger, it's often a good trigger. But if you look here at, for example, October, we can continue the upside even if we're topping out. And the same we have here in November, December. And there are a few ones that instantly fall flat on their face. Again, nothing works all the time, but I have no sell signal, at least not yesterday. I don't know what the reading is for today. I think this is simply going to top out. It's going to take a little while, and I'll show you in a minute why. So also that one is not bearish. Bearish is when things are going lower, and so far it's moving higher. Breath thrust, this is the Swike breath thrust indicator. Didn't do all that great. Got to be honest, we don't need a thrust to get higher markets. We didn't get a thrust in 2020. Look where we are now. We did get a thrust in 2019, and what happened? So again, a thrust is not necessary to get much higher prices. But again, here the Swike reading is all not too wow. But again, nothing that's weak either, so it's neutral at best. So we got to be objective and do the weight of the evidence looking at all these different indicators. Okay, so we've gone through breadth and we've seen some amazing readings never seen before in history. So that we need to take into consideration. Here is then the Nasdaq, the regular Nasdaq, with the impulse pattern, which is my preferred path that I'm tracking for the initiation wave to new all-time highs. We could have topped here for 3, now in 4, and then in 5, and we have an extended 3 on our hands. Okay, normally the third wave tops here, the fourth wave bottoms here, and the fifth wave tops there. Now, since we topped right here at the 200% extension, it could be possible that we indeed topped, and that we only had a one-day wave 4. Okay, it's very possible. If that's the case, then we're in wave 2. Wouldn't surprise me if that's the case based on these extreme market breadth readings that we need to digest these strong rallies that we've seen over the last few days in many stocks. So yes, we topped here right at the lower end of the ideal target zone, missed the wave 4, and now we topped right here. If this is the case, we need to start breaking, I would say, below 14,000 to suggest this wave 2 is underway. It's too early to tell. Otherwise, we can simply extend and move higher. Let's not go into hourly charts. Let's go same here for the Nasdaq. The Nasdaq 100 also reached the 200% extension. Okay, we reached the bullish wedge breakout target of 15,200. That was in the charts. It's the same for the S&P 500. Remember, I'll show you that real quick here. Let's see if I can find it. Not this one, not this one, not this one. And there, this is the bullish wedge that I showed already on March 16, was on the breakout, and look where we got. We already surpassed this, okay, 311, bullish wedge. I already warned you even before that this looks like a bullish wedge. Remember, that is the condition, right? The condition is a bullish wedge. Now the market needs to act upon it. When does it act upon it? When it breaks out from the bullish wedge. It did so on the 17th, and look where we are now. Voila, this was a easy 6 to 7% trade on a closing basis, very simple. However, based on the technical indicators here for the S&P 500, I don't think we're gonna just collapse, which the bears always want. I really start to call out the bears on Twitter, by the way, because I'm nauseatingly sick from them. But everybody's the right to the opinion as long as it's correct and not just some biased BS. Look at the technical indicators. This doesn't tell me that we're going to top it anytime soon. We can, of course, but again, same here. We had the wedge. We've reached the wedge pattern. Now the question then is, did we top? Same as for the Nasdaq for wave 5 of 1. We need to drop all the way for below, I would say 14,500 to confirm. That's quite some ways to go, and by then we're almost already in the ideal wave 2 target zone anyway. But you know, one snowflake doesn't make it a snowstorm yet, but it can be the initiation of a snowstorm. So we'll monitor it diligently. How are the technical indicators doing? I see no negative divergences here either. So neither this suggests that we have topped. So we could continue to see a melt up like the rally we saw from the March 2020 lows. It's very possible. Then we look at some other indexes. And again, if one index is still subdividing higher, the other index doesn't necessarily need to do that. Just as we had, of course, the S&P 500 top in December, the Nasdaq topped in November. Okay, so we always have to be cautious and not overinterpret things and try to find correlations where there are none. We treat every single index for their own merit. Looks like we topped here for green wave 3, green wave 4, green wave 5. Possible. I would like to actually see a little bit higher high based on the microstructure I see of this green wave 4. It would count better as 1, 2, 3, 4, 5, and then we roll over for 4 and a 5. So this suggests that the Nasdaq and NASDA100 also should see a 4th and 5th wave, so to say, but it's not necessary. So please keep that in mind. We know the cutoff levels. The Dow Jones needs to break below, I would say here, the wave 4 low here to even suggest that this C wave, not an A, B, C, right? That this is just a bounce. We need to break below this low. This is the bullish cutoff. Let me put that in the chart. Let's do here trend line there. We need to, because then we start making lower lows. This is really a bullish cutoff from current levels, right? Current levels. If we don't break below it, yes, we can for this wave 2, but I'm talking about the current rally. That's the bullish cutoff for now. As long as we hold it, we should be fine. S&P 500, same here. We remain objective and that it can be a bounce, an A, B, C, though the market breadth readings, as I showed you, tend to suggest this is not the case. Okay, so based on that one single reading for the NASDAQ100, which got close to the current reading, right? One was at the end of the bear market and the other one was at the top of a bounce. In 2011, we could see a 20% correction. Well, if we're going to see a 20% correction, we're going to go down way lower. Possible, don't see it yet. We've reached 161.8% extension. We just have a one-day pullback. I don't want to overinterpret it. It looks more like, well, yesterday was such a crazy breath reading, so yeah, we need to take the foot off the gas for a little bit. But again, we remain objective till we see 5 waves up. We haven't seen it yet. 1, 2, 3, 4, 5. So this can easily drop to about 4,500. Wouldn't surprise me. And then we're rally. Okay, it wouldn't surprise me. But look at the strong MACD reading. This is not a MACD reading that just suggests we're going to collapse like this. If anything, look here, these type of MACDs, what happens? Continued upside even after some pullbacks. So yeah, we can have some pain. That's fine, shorter term. Forest versus the trees. So again, here's the NYSE. The NYSE only did a 38.2% retrace, not even 23.6 actually, of the all-time high to the lows in February, March. Now, literally, yawn, wake me up, when something really earth-shattering happens for this index. Technology corrected more, but technology also rallies more. So you stretch the rubber band, it will release it, it will snap and hit your fingers harder than when you don't stretch the rubber band so much. And the NYSE did not have such a stretched rubber band. Right here in the ideal wave 4 target zone in red and black, it doesn't get any more picture perfect than this. And look at this, we are almost at the all-time highs. It's hard to become bearish if we're getting this close. Same here for the equal weighted index. It did a 11% correction right here in the 23.6% retrace of this entire third wave rally. And now we should see another fifth wave to go. Let's have a quick look on how close we are to the all-time highs. 2% away. It's hard to get bearish on this. Okay, so far it seems to be just a overbought pullback. What does it take to turn bearish? Below the February lows. Really, that's really what we need to see. Otherwise, wake me up tomorrow. Right. That said, here are your assets to your advantage. Use them. Read about Elliott wave. All this good stuff. Remember, there are no gurus and market gods and all that stuff, or there's no that will tell you exactly everything that happens. We do the weight of the evidence approach for the most likely path forward. So, bottom line is that several markets just experienced incredibly strong market breadth readings. In fact, the Nasdaq has seen a reading that's never seen before. What can we conclude from it? Well, from that, it's almost impossible to conclude anything other than that is strong market breadth. Bears need to see negative market breadth. So we don't have it, so it's bullish. Otherwise, I don't know what to say. Such extreme readings are often associated with kickoff waves or near the end declines of massive bear markets. Well, we haven't had the multi-year 50, 60, 70, 80% decline. So it's not really feasible to compare those bear market ends with current readings. Well, anyway, such extreme readings are also a sign of very overbought internals. We need some backing off, hence why we have declining indexes today. Okay, you cannot go much higher in the McClellan oscillator for the Nasdaq 100 than this. So we need to back off a bit, all right? Too much of a good thing. Now the question is primarily for the Nasdaq and Nasdaq 100, if we've seen 5 waves up already, because price reached a 200% extension, which is normally reserved for a 5th wave. But I showed you that the Dow and the S&P 500 align much better for a wave 5 of 3 of 1 top, okay? Again, align much better. We can also have for a wave 3, sorry. We have wave 5 of 3, so it's a third wave of a first wave. Then we still see a 4th wave and a 5th wave within this wave 1. Okay, based on market breadth and the Dow Jones and the S&P 500 as well as the technical indicators, I prefer this wave 5 of 3, which means the Nasdaq 100 could extend. It's not necessary because each index must be assessed on its own merit. As I showed you, the Nasdaq already topped in November, and the other indexes not until December. So there can be discrepancies. We know the price levels to watch. Now here in blue are a few anecdotal lines of evidence, I would say, or quotes that I found in an article. I can't find the link to it anymore. I'm sorry about that. But one question was, why are the markets rallying? Because we have inflation and I don't know what. Well, this lady, I think, said that investors use equities as a hedge against inflation. Okay, because inflation stands at the highest level in nearly 4 decades. It's actually a good point. So why not buy a Tesla that goes up 20% and you beat inflation at 7%? So it's better to buy stocks that go crazy than to go into something that doesn't appreciate as much. Okay, so then again, here's a forest through the tree statement. This person here, the long-term bull market punctuated by panic attacks remains intact. I fully agree. We had a panic attack in January and February. Everybody was running chicken littles, and look where we are now. Now, folks, if you can't handle a 15% correction, you're going to shit your pants when we hit the 80%. But as I showed you for the Nasdaq 100, even an 80% bear market, it's not the end of the world. It really isn't. So I would say if you see those updates where they say, move out of the city, start growing your own vegetables, buy a gun, stash of gas. I don't know what you're trying to sell, but I have more faith in humanity than that. So it looks a little over the top to me, right? We remain level-headed. That's the best way to go through life. Bearish sentiment remains, however. This is from a large portfolio manager, a couple of billion under management. They're holding slightly higher than normal cash levels. Doesn't say what. Is that 5% higher, or are you? I don't know what it is, but they're wary that the bear market rally could turn around and that we can retest the lows. Based on all this weight of the evidence, I don't think that's going to happen, but the market can always prove me wrong. We have our bullish cutoff levels, but again, it shows you portfolio managers are still a little bit hesitant. So in case you wonder, right, what's the level we need to look at? We need to drop for the indexes below the fourth wave lows in case these are fourth waves, right? So that is for the Nasdaq. I'm going to pretty much put it in there, the cutoff level. And maybe tomorrow we have a massive down day. Who knows? Maybe some bad news hits the wire. So this is our cutoff level. Okay, I'm going to put it in there. We don't want to see indexes drop below that from about current levels. Oh, thank you for not saving. It's okay. I'll get that done. Same here, bullish cutoff level right here, there in blue, right? We don't want to see price go below there. That is, of course, our bullish cutoff level right there. Why? Because then we start making lower lows, and I don't like it. Anyway, that is all for today. I think I've spoken enough. Thank you so much for listening. Take care, trade safe. See you all on Friday. Bye.